Anyway, we got through a couple of areas. We had. Okay, here we go. We had three different categories in terms of how much of the company's stock you own, right? Again, if it's bonds or if it's preferred stock, it's all no control, right? Okay, so there's a category for no control. How much would you own of the common stock that you have no control? Or it's preferred stock or it's bonds to be in there too, right? What would that be? 1 share to about 20%, right? Rule of thumb. Okay, and then what do we have? The next was 20 to 50, and what do we call that? Significant influence, right? All right. Okay, and then the last category, of course, is over 50. And what do we have there in terms of control? Control. You're in charge. When you vote, you win. Okay, so that's pretty straightforward, isn't it? Okay? And then what do we call these within each one of these categories? Okay, what accounting method do we use, and what are the accounts called? Okay? So in no control, these are marketable securities. The whole group is called marketable securities. Got it? Because they're securities that are marketable, so you can call them that. 3 categories based on what? How long you're going to hold it. So let's do how long down here. This is how much control across here, right? How long down here. Okay, and what's the first one?
1 day to a few weeks.
Okay, 1 day up to a few weeks. Very short term. And what do we call that? Trading securities. Very good. Investment in trading securities. Got it? Pretty straightforward, isn't it? Okay? And then what's the next category? More than a few weeks, up to what? Up to 1 year. Excellent. Okay? And what is that called? Investment in, available for sale, less than a year. Short term. Absolutely. Right, guys? This is real straightforward. After you see it, it's straightforward. When you're reading the chapter, it's kind of like, whoa, what are you doing? But it's not that. Okay, so we've got trading securities, we've got available for sale short term, and then what if it's over 1 year? Indefinitely, maybe, right? But in the case of a bond, less than maturity, okay? Preferred stock, any period of time, right? A bond, less than maturity, otherwise it would be called held to maturity, investment held to maturity, right? Bonds, you know how to do that. Amortize discounted premium. Okay, if it's common stock, right? If it's less than 20%, even if you're planning to hold it forever, right? You're still in this category. What is it? Available for sale? Yeah, nothing to this, right? Investment in available for sale, long term. Okay, we got it now. Right? What do you do with the dividends in this case? Dividends are what? In all 3 of these, dividends are what, gang? We did that last time.
Revenue.
Dividends are going to be dividend revenue. We record the revenue, don't we, for our share of the dividend, debit cash and credit dividend revenue, right? Or you could debit dividends receivable, dividend paid yet, right? Credit dividend revenue. Okay, what are we going to do with the increase or decrease in market value? Because I'm taking what the market's given me as dividend revenue, right? And because I'm taking what the market's given me, what are these going to be? Unrealized gain or loss. Got it. Unrealized gain or loss. Nothing to this. So I'll record a gain, obviously, if it goes up in value, so I'll debit the asset account, trading securities available for sale short-term or long-term, right? And I'll credit unrealized gain. It's unrealized because they didn't sell the stock and don't have cash yet, right? That's what we mean by unrealized. No cash changes hands. Okay? All right, how about the loss side? If the stock goes down in value, I'll credit those asset accounts, right? Trading security, available for sale short-term, available for sale long-term. Everybody agree with that? Okay, and I'll debit what? Unrealized loss on trading security or on available for sale short-term or available for sale long-term. Got it? Okay, now, key thing. Where does the gain or loss go if it's on a trading security? It is a what kind of account? What's that?
Expense.
Well, it'd be like an expense. A loss would be like an expense. The gain would be like a revenue because it increases. Gain increases your net income. Oh, key thing is what? It's on the income statement. It's an income statement account, right? It's an income statement gain or an income statement loss, right? It's the income statement, and therefore gets close to retained earnings. Okay, now that's on trading security. What about available for sale short-term or long-term? Because they had this compromise. Nobody wanted to run all those gains and losses through the income statement, right? Said that last time. And the author said it too. So what happens to those gains and losses? They go straight into equity in what? Other comprehensive income. Other comprehensive income. So we have a third category now of equity. We have contributed capital, retained earnings, and other comprehensive income. And all the political hot potatoes end up at other comprehensive income. So do you want to look at other comprehensive income and see how much their losses are in the stock? Also, it's unfunded pension liability is up there. It's bigger than retained earnings for a lot of companies. Wow, right? It's also foreign currency gains and losses. But if they're holding a whole bunch of foreign currency and the bottom falls out of that currency, that's where the losses would be. So are also the gains and things. Okay, so some companies show gains, some show losses. You always want to look at that. Okay, so if you're not going to be an accountant, know to look at the equity statement, look at other comprehensive income, and try to figure out what's going on here. What would you think if the debit balance and other comprehensive income is bigger than contributed capital and retained earnings? They are bankrupt, even though they have positive contributed capital, positive retained earnings, right? Okay, and trucking industry, that kind of happened to them because they owed so much on the pensions, couldn't afford to pay it. Okay, good. So that's the world there, huh? Oh, where do we put the gains? The trading security ones go on the income statement, right? Gains and losses. Where do the avail for sale short-term and long-term come? Other comprehensive income, right? We got that? Everybody got it? I said it, I just want to re-emphasize that. Okay, here we go. Significant influence. What do we call the account? I have an investment in what? Investment in an affiliate. Okay? You can call them an affiliate. That's it. Okay? Investment in an affiliate. And you might say investment in affiliate XYZ company. Got the idea for their name on it. Okay, usually on the trading security available for sale short-term, long-term, we don't bother. Because you have a whole bunch of investments, right? A whole bunch of different companies. But an investment affiliate, you would never earn any of those. That's before where you own 20 to 50%. Okay? What if I control it? I have 50 to 100%. It's an investment in a subsidiary. Right, gang? That's it. Okay? So you need to know these terms, obviously. Okay? Maybe. All right, now what was the method we're using? I didn't write it down, did I? What's the method we're using where we are recording the dividend revenue, we're recording the change in market value? Oh, I left out one thing. What about if there's a net income or a net loss? What do you do in this situation? If it's no control. No entry. Why no entry? I did not make the income or loss happen. I do not run the company. Got the idea? So I'm taking the dividends that I earn, recording them. I'm taking the change in market value that I got, whether it's good or bad, positive increase in value, negative decrease in value, gain or loss. I record that, but I do nothing for net income, huh? Because I didn't make the net income happen. The whole world changes when you go to significant influence. It's a whole different way of looking at it. Now I'm helping run the company. Okay, so what was this method on no control? What did they call it? What do we call it? What method are we using? Market value method. It's mark to market. You'll hear that term. It's the market value method. I am going to adjust the market value at the end of each year. Got it? Mark to market, we call it. Okay, everybody good? All right. Affiliate? Equity method. And the reason is I have a significant equity stake so that I am helping run the company. I have significant influence. Equity method. Got it? So what I'm going to do, listen to this one kind of carefully. As they change their retained earnings, I change my investment by my proportionate share of it. When does a company change their retained earnings? When do you increase your retained earnings? When, at the end of the year, when you close your revenues and expenses and you have a positive net income, you close the net income to retained earnings. Let's say I own 40% of the company, and they earned $100,000. What's my share of it? 40. What would they close the retained earnings? 100,000. What would I add to my investment? 40. I'll debit the investment, no credit income from affiliate, which will hit my retained earnings too now. What if I pay myself a dividend? Okay, what does the company do when they pay a dividend? Or declare a dividend, at least. What do? Debit what? Let's say it was a $30,000 dividend. Same company, $30,000 dividend. What would they do? Debit what? Well, credit dividends payable, or credit cash. They went ahead and paid it, right? And debit what? Retained earnings. They reduce their retained earnings by 30. How much of the dividend are we going to get if we own 40% of it? 30,000 times 40%. What are we going to get? That's 12. 4 times 3 is 12, right? If it's a $30,000 dividend, right, and we own 40% of the stock, they're going to give me 40% of the dividends, right? So I get 12,000 of what? Dividend receivable if they had a dividend payable, or if they went ahead and paid it, what would I have? Cash. I debit cash. And what would I credit? Not dividend revenue. I paid myself a dividend. What would I credit? No, I don't have more income from affiliate. I would credit investment in affiliate. I'm paying myself back some of my investment. Oh, so when my investment earns, I increase my investment in affiliate. Make sense? For my share of it. If I pay myself a dividend, I reduce my investment. It's kind of like you put your money into a savings account. It increases in value. You record an increase to it and record income. And then if you take some out, what would you do? Reduce your investment. Debit cash, credit the investment. That's all that's happening here. What would I do with the change in market value? Absolutely nothing. Right? It's great it went up. Or it's sad it went down. But nothing. Oh, so it's totally different than this no control environment over here, right? Totally different. So let's try an example of this, okay? And this is going to be the equity method. So let's make up a company again. XYZ company. 1 million shares. This time I purchase, okay, well, this is sort of the same thing. Market value is $10, that's fine. At the purchase date. $11 market value at the end of the year. Okay. We purchase, so it's XYZ stock, right? Common stock. We purchase, that says purchase. Oh well, anyway. We purchase 350,000 shares. Okay? Oh, and they report, so end of the year it's $11 market value, and they report net income of, what did I have before, 100,000? No, it's 250, wasn't it? Last example, same one, 250, and then they pay a dividend at the end of the year of 100,000. Here we go.
Do you want to use the same example as last time?
That's pretty close. Is that it?
Purchase was 1,000 shares.
Oh, no, I don't want to do that. You know why I don't want to do 1,000? What do I have now?
No control.
No control. So the only thing I do want to change is this. Nice observation, though.
Okay.
Because now I've bought what percent? 1,000 was what? What is 1,000 as a percent? 1,000 out of a million? What is that? Is that 1%? Or is that 1/10 of 1%? I think it's 1/10 of 1%. Yeah, it's 1/10 of 1%. I certainly don't have any control, right? Okay. How much control do I have now? 350 out of a million is what? 35%. I have significant influence. Well over 20. Right? So I did want to change that one. So thank you. That's perfect, though, right? See what's going on? And I got everything else the same, do I? Is the other example? Since last Friday, that's pretty good. Old guy, how did I ever remember that? Okay, anyway, it's backwards.
Yeah.
They say you can remember everything you ever knew. You just can't access it. It'd be cool if we ever cracked that one. So everything ever happened in your life, you can remember it. Wow. I can't remember what I had for breakfast. Truthfully, I can. My wife makes me eat toast every morning, whether I want it or not, with jam. Yeah. Anyway, because I'm a bad for not eating breakfast at all. So. Okay. Anyway. Sorry, I'd be dead if I didn't have her. So, oh, she doesn't want a $45,000 car anymore. Now it's 35. It's like I won the lottery. Wow, cool. So anyway, was it in this class somebody had a mom with a Honda CRV with everything you can possibly put on one? She says, well, there are no options. Isn't this a great car? Well, yeah, there's no options. The base one's 22,000. This one's 34 or something. There's no options though. Got it? No options. It's funny. Okay. Anyway, so. But I'd be dead if even that, I could juice to survive today. Okay, anyway, so what do we do here, guys? Let's account for this. I want you to do three things. I want you to tell, well, 4 really. I want you to tell me what happens at the date of purchase. You know, that'd be earlier in the year, right? Record the entry for the purchase, okay? Let's do that. So let's say that's January 10th. Doesn't matter what it is, okay? And then or it was last year or something, whenever you recorded it, okay? And then let's record the entry that you would do for the change in market value. That means change a little, right? We'll try. Change in market value, do that entry. And then do any entry that you would have for net income, okay? Net income or loss, okay? Do that entry. And then let's add one more. Let's do the entry that we would do for the dividend. Everybody got the idea? So those are the same 4 things that we did with trading securities available for sale short-term and long-term last time, I think. Exact same stuff. So give those a shot. So it's 350,000 shares at $10 a share. What'd you pay for it when you bought it, probably?
Cash.
Cash, yeah, almost always. Okay, so you could obviously give it another asset, but probably cash. You guys have really figured out how to do this class, haven't you? I tried to tell you the first day. But you got it now, you got it wired. Just soak up everything and do it, right? Use your intellect, of which you guys have lots. Lots. So tired of hearing faculty say students don't work hard like they used to. And they're not as smart, they don't have better K-12 education. We were all lazy too when we were your age. We all needed somebody to push us. It's human nature. And none of us had ever worked hard. Had to figure out how to, right? Got the first journal entry? Let's do the first one real quick. How many dollars were we given?
3.5 million.
3.5 million. So you have what, less cash? It's an asset, you reduce it with a credit. I'm a funny guy, right? But don't, as you're doing the final, don't lose track of that, right guys? Please don't, right? You know, use what you know. By the way, on the final, I'm going to give you about 1/3 of the final is going to be from the first exam. You know, debits on the left, credits on the right. You know how to increase and decrease accounts. It's knowledge you got in this class. It's a comprehensive final. Don't you love comprehensive finals? Students say, oh, no, I don't want a comprehensive final. Are you crazy? You know, all that early stuff that's easy, you want me to leave it off? I'll just give you these last 2 chapters, okay? No, you don't want that, right? Yeah, so it's great. It's all building, right? So, sure. It's okay. You learn. You get credit for it. 3,500,000 of what? Investment in what, gang?
An affiliate.
In affiliate. That's it. You got to remember it's an affiliated company. Investment in affiliate XYZ company, huh? I'd probably put XYZ company on it. Don't just say investment in XYZ company. I can't tell if that's a subsidiary or an affiliate. Got the idea? Okay? So we got that one. Okay, change in market value. The market value went up. What's our stock worth now? It's not worth 350,000. What's it worth? It's not worth 3,500,000. What's it worth? 3,850,000 because you got $1 a share more. Good man, right? Are we going to record that? No. Are we happy about it? Yes. But we're not going to sell it anyway, right? Okay? So what are we going to do with this? What are you going to tell me? This is at January 31st if that's the year end, whenever the year end is. What do you think? No entry. Tell me no entry. Got the idea? That would be different if it was trading securities available for sale short-term or available for sale long-term. Am I right? You'd record that. Okay, what about the net income? I helped earn the net income, didn't I? What portion of the net income did I earn? 35%. So I think my investment is worth more, right? I'm going to record that into my investment. I'm not worried about what the income statement is showing. I'm worried about what's happened. Well, I'm sorry. I'm not worried about what the market price is showing, right? I'm worried about what they're earning because I'm earning part of that. Got the idea? Okay, so they're increasing their retained earnings by 250,000, aren't they? Right? XYZ company is for that net income. I'm going to take 35% of that and add it to my investment, okay? Because I own that much of the retained earnings, huh? Got the idea?
35%
Okay.
of the 250.
You got it. And why is it 35%?
That's how much you know.
That's how much I own. Yeah, you got it. I own. Well, way to go, Keith. Wrote it too long here. I own 35% of this company, so that's what we're doing the whole time, right? I own 35% of it. So I get 35% of the dividends, I get I earned 35% of the income. So here we go. Debit what? I think my investment is more by my share. How much is 35% of 250?
87.
87,500, right? So $87,500, right? What do I want you to debit for 87.5? What do I think is worth 87.5 more? My investment in the affiliate. You got it. Investment in affiliate XYZ. Everybody got the idea? It's easy, isn't it? Credit what for 87.5, of course? I earned it. Well, it's not an unrealized gain. It's not adjustment to market value. Instead, we just call it, well, a couple of things. Did the author call it equity interest in affiliate income? Something along those lines? Some ridiculous name. Earnings from affiliate, income from affiliate. It's a income account that's going to go in that non-operating section. Remember on the income statement, you have all your revenues, less your cost of goods sold is your gross profit, less your operating expenses is operating income, plus and minus all your non-operating items, right guys? Gains and losses, other revenues, other expenses. This is other income, okay? It might be big on a company, right? But this would be, we can just call it for simplicity, income from affiliate. Or you can call it equity interest in income from affiliate. You like that? So if I have several of them, I might call it income from affiliates, if I have several affiliated companies. Got the idea? This is an income statement account, right? Everybody got it? Okay, income from affiliate. So debit investment in affiliate, credit income from affiliate, and we're there. Okay, because I helped earn that income. I helped earn the 250. And what share is mine? Well, 35% of it. Got it? Okay, then what's going to happen to the dividend? Let's say they pay the dividend, declare it and pay it the same day, which of course they wouldn't. But let's say they declare it and pay it the same day. Make life simple. Okay, so we don't have dividends payable on it. Okay, so what would we do here? They send me a check for how much? It's 100,000 of dividends. What do I get? 35,000, of course, because I have 35% of the shares. What do I want to debit? Credit what? I'm going to reduce the investment because I decided to pay myself back some of my investment. That's the theory. See how this is different than you have no control, you're just taking what the market gives you, so it's dividend income, right? Dividend revenue. That makes sense? Okay. And I record what happened to the market price. It's unrealized gain or loss. And I don't do anything with the net income because I'm not making the net income happen. Here I'm making the net income happen and I decide to pay myself a dividend. When we voted whether or not, trust me, I'm on the board of directors, so I own 35%, right? When we vote, did I vote to give myself a dividend or what? Yes. Got it? That's the idea, okay? Anyway, so I debit cash for 35 and credit what for 35? The investment in affiliate. XYZ company, right? Everybody good? Yes, sir.
Does that mean that whenever you pay yourself dividends, you now have less control of the company?
No, I still own 35% of the company, but I have less investment because I took some of the investment out, and I have more investment because I earned, right? The theory of it, right? This is conceptual stuff, more, you know. It's not a reality kind of. That's what we're living. It's not a reality. You're trying to reflect economic reality, but it's theoretically what is it, right? That kind of thing. Let's do this. This might be helpful. Let's look at what happens to the retained earnings of the company with these entries. Let's look at what happens to the retained earnings of the company. So this would be on XYZ's books, right, everybody? Retained earnings on XYZ books. And then on our books, whoever we are, right, we have investment in affiliate. XYZ, right? XYZ company. Okay, so what do we start with in the investment in the affiliate? We invested how much? $3,500,000, right? Okay, so we got that in there. And they've got whatever they have in beginning retained earnings, some big number, okay? Whatever they have. What are they going to do this year to their retained earnings? What net income do they have? 250. So when they added 250,000 here, what did we do? we added our share, our 35% of it, 87.5, we added to our investment. See, we're tracking right with their retained earnings. Okay? Then what? They paid a dividend. This was their net income. Then they also paid a dividend, didn't they? How much was that? 100,000. Okay? And what does that do? Here's our share of their net income, and that'd be income for me, right? I debit the investment and I credit earnings from affiliate, right? Or income from affiliate or something like that. What would I do with the dividend? I take my share of the $100,000 dividend out of my investment because I paid it to myself. Got it? It's like I paid myself a dividend, sort of. Paid myself back part of my investment. And how much was that? 35,000. So notice that the retained earnings went up by 150, and my investment went up by 35% of that. Everybody agree with that? My investment went up by how much? 3,532,500. Is that what that is? 52.5. 87.5 less 35.
52.
Yeah. You got it, guys? Not too bad, huh? Can you do that? That is a hard job. It's just there's so many of them, huh? But it makes sense, doesn't it? To do it the two different ways. Market value method if you don't have control. Equity method if you have significant influence. Okay?
So net income, when you're like taking a 35% out, you're not taking like their net income out.
No, I'm adding their net income. I'm adding their net income to my share of their net income, to my investment and to my retained earnings.
So it doesn't affect the company.
It doesn't do it. Oh, whose books are these journal entries on? Ours, the company that made the investment, right? There's no journal entries on the affiliate, these books. They're just doing a normal accounting, right? We just look at their financial statement and figure out what our share of it is, and we record it on our books.
So the only
Got it?
thing is like dividends when you're actually paid the cash.
Yeah. This would be on their books, right? They close their net income in and they'd have their dividends. By the way, what if it was a loss? They would debit retained earnings and we would do what? Credit the investment and debit loss from affiliate, right? Make sense?
Is this investment in affiliate, like the 3,552,000, that's how much that shareholder stocks are worth if they were to sell it all now?
No, that's what we're going to have on our balance sheet for our investment in that company.
Okay.
What it's worth now is $11 a share times 350,000 shares.
So
Right?
is that cash or is that shares?
No, these are dollars.
Okay, that's what I thought.
These are
There's no
dollars,
dollar
but
signs.
we invested $3.5 million in the company.
Okay.
And all we're doing is we're keeping track of how much we think our investment is growing because of our share of the income, less how much we think our investment is going down by our share of the dividends.
Okay.
We're not doing anything with the market value.
Okay.
Okay? Because we don't think the market value matters because it fluctuates up and down. Doesn't have any impact on us because we're not selling our stock anyway.
Okay.
Okay? That's sort of the
That
theory.
makes sense. There's no dollar signs.
Yeah, those are dollars. They're all dollars. Yeah. It's 350,000 shares in every case. But what's the stock worth, you guys? Take 350,000 times 11 bucks. What would it be worth then? It's 3,850,000, right? So it'd be 3,850,000 is what it's really worth.
Okay.
But we're not selling it anyway. If we tried to sell it, it's not worth that anymore. You know why? Because we own 35% of the stock, and we're going to flood the market with that stock, and the bottom's going to fall out of the price. It's worth $11 if you're selling it constantly, right? Or I'm selling pieces of it, yeah. But if I have no control, what happens if I sell my stock? Doesn't matter. Although at 20% it probably would. But at 1% of the stock, probably not. Certainly at 1/10%, and they wouldn't even notice. If you only own a few shares. That's a great question. Okay?
All right. That would be for common stock, right?
Yeah. On preferred, the preferred stock would work the same way, but preferred stock is always either available for sale, short-term, long-term, or a trading security, right? Because we don't have a vote. Now, if it's voting preferred stock, it gets more complicated. We're not going there. Okay, not now. Do it. Hey, coach, all you need to know is left and right. The assets going left, it's all common sense after that, right? Still kind of true, isn't it? It's just understanding the business transactions. That gets tough. There's a lot to it. Okay, so what do we have left, you guys? We beat that one to death a little bit. What do we have left? Subsidiary. Okay, and the author doesn't do very much with subsidiaries. In fact, what they do is they have a company, they buy a company and merge it, don't they? Right, which is the way you can go, you know, obviously, and that's fine. Read through that, know it, right? Know what's going on. Okay, so that's that. If you buy a company and you merge it into your company, they cease to exist. They're gone. You buy all their assets, all their liabilities, right? And therefore all their equity, right? You could either buy the stock or you could buy the assets and assume the liabilities. Either one. And then they could retire all the stock if there's nothing left, right? You have no assets, no liabilities, the stock's nothing. Okay? So it's done both ways. So they showed you that. What I'm talking about is, in this one, is I buy more than 51% of the company. By the way, this is a real pain. Let's say you had less than 20%, so you thought you had no control, and then you buy 5% more, say. And now you're up and you have over 20%. Guess what? You have to switch methods and go back and retroactively restate it. What if you own 49%, say 48%, and you buy a few more percentage points of shares? Now you have over 50%. Now you have to consolidate. So you'd have to redo all the accounting. I won't do that to you either. And then in subsequent years, of course, I mentioned that last time, in subsequent years with the subsidiary where you have control, right? You'd have to restate retained earnings year after year after year after year as long as you own control of the company. So this gets to be a horrendous job. It's really big. But the concept stays the same. Okay, so if this is market value method and this is equity method, what's this one over here, gang? That was equity method, right?
Consolidate.
We consolidate it, absolutely. Which means what? Consolidate or consolidation. What is it? We are going to put them together, right? All the companies together. So imagine Young Brand maybe owns 100 other companies. Imagine a big spreadsheet. What they do is they use multiple spreadsheets and add some of them together. But you could imagine a big spreadsheet with 204 columns. The first two columns are Young Brands. All their assets, liabilities, and equity. Got the idea? Just add them all up, right? It's going to be their total balance sheet, income statement, everything all down, right? Trial balance. You guys know what that is. Okay, and then we have two columns for every single one of their subsidiaries. Got the idea? All 100 of them. All their debits and credits, all their debits and credits lists, all their assets, right? And you put them next to each other, so cash is all the way across, receivables is all the way across, inventory is all the way across. Got the idea? Right? And so now you've got, so there's two columns for each one of the subsidiaries. So now we got 202. And then, I lied, there's going to be 206 columns here. Then there are going to be two columns for something called an elimination journal entry, and that's what we're going to do here. Elimination journal entry, and you eliminate all the intercompany stuff. The parent is showing, the parent company, in this case Young Brands, the parent company shows investment in each of these other companies, right? Investment in subsidiaries. Big number. It's on their balance sheet, their own independent one. When you consolidate, do you want to show investment in yourself? Of course not. So we're going to get rid of the investment. The investment in subsidiary, what do you think? It's an asset, right? It's going to have a debit balance. How are you going to get rid of it in elimination entry? Credit. That's it. Now this elimination entry is not going to go in anybody's books. Only on the worksheet, right? Because you're not going to change Young Brands' books by getting, why would you get rid of it? They still have the investment, right? You're just going to get rid of it in the consolidation. What else are you going to get rid of? All the equity of all the subsidiaries, because that's what Young Brands owns. Young Brands owns. We're going to eliminate it, right? Get rid of it. Okay. So if we get rid of their investment with credits, how are we going to get rid of the equity? All of the common stock, additional paid-in capital in the common stock, preferred stock if they have an additional paid-in capital on that, all the retained earnings. How are we going to get rid of all this stuff? For all the subsidiaries, all 100 companies, how are we going to get rid of all their equity? They all have credit balances. How do you get rid of it in the elimination? Debit for the amount. So it gets pretty simple. For the full amount, it's huge credit to investments, right? Huge debit to all the equity accounts. And remember, the investments are on the parent's books, right? And the equity accounts are all on the subsidiaries' books. So do you put this on anybody's journal ledger? No, it'd be a one-sided journal entry, right? Only in the worksheet. Got it? So these two columns towards the end of the worksheet are really important, right? Where you're doing all these elimination entries. We're gonna also eliminate any intercompany debt, because you don't want to, because you owe yourself money and you had a receivable for yourself, it'd be ridiculous. Receivable and payable to myself, doesn't make any sense. But anything that's intercompany goes away, right? Imagine all the things there could be. Leasing arrangements. Oh, intercompany revenues and expenses. Profit, intercompany profit left in inventory, you gotta get rid of it, right? I'm not gonna do any of that stuff to you. We're just gonna do it at the date that you buy the stock, at the date of acquisition. If you were going to do an elimination issue, what would it look like? So you get the idea of what happens here, okay? That's what we'll do, right? Anyway, oh, and that last two columns in my 206, I guess. First two columns, the parent. Next 200 columns, all the subsidiaries, right? Debit and credit for each of them. 2 columns for the elimination. No kidding, way over at the end, right? 2 for the elimination. You eliminate everything for all of them in the 2 columns, right? One massive journal entry, okay? And then the last 2 columns are what? Consolidated balances, and you use those to do what? Consolidated balance sheet, consolidated income statement, and consolidated cash flow statement. All together. Got it? This is a big job, right? And for any Fortune 1000 company, that's what they're doing, okay? So it takes some skill, takes concentration, I guess. I don't know. Okay, so but the concept's pretty simple. So let's try this with the same company, only we'll add a little bit of, well, first, how much do they have to own? Anything more than 50%, right? Oh, there's one other thing. We have to record the minority interest. Because we don't own all the stock properly, right? We own less. And we'll just have the parent and one subsidiary, okay, for our example. Yeah.
So it's not 50 or greater. It has to be greater.
Greater than 50, yeah. Well, right at 50, you got to make a judgment call.
Yeah.
Do we have control or not? Yeah, so it's either an affiliate or, yeah, same, right? But yeah. But usually you won't be exactly to the, share 50%. Could be them. Okay. All right. So let's say we own 80%. How much do the minority shareholders own? We're the majority shareholders, huh? We own 80%. How much do they own? 20%. Duh, right? Okay, that's going to be pretty simple. Okay. And here's the cool thing. We are not going to use the market value method. We are not going to use the equity method. You can use either one if you want, although nobody used the market value. What for? Okay, you could use the equity method if you want to on the subsidiaries for your personal financial statement, for Young's financial statement, right? They could do it if they want. Usually we don't. We don't bother because they're going to be consolidated anyway. Okay, it's work and it doesn't mean anything. Okay, so when you're doing consolidation, all you really do is the elimination. Right? Put them together and eliminate. Okay, so let's give that a shot. Okay, so let's get sort of the same company. What did I have? XYZ company, was it? Mm-hmm. So it's how much you own of the company is the point I really want to make, right, guys? Okay, XYZ company, we had 1 million shares. Let's say there's still 1 million shares of common stock. That's common stock outstanding, right, guys? Common stock outstanding. Okay, anyway, let's say the market value is $10 when we purchase it, right? And let's make it $11 again, whatever it is. Could go down, of course. Year end. Okay. And this time, let's do no dividends. I don't want to do that because it complicates things, so I won't do that. Net income, what did we say it was? $250,000. Okay. And all we'd have to do if there were dividends is eliminate them. You can't pay yourself a dividend. That makes sense? And if you did use the equity method on the income, guess what? You'd have to eliminate it because it's with yourself. Okay, so let's not complicate things that way. Okay, let's say we buy 80% of the stock. So our purchase is 80%. Okay, so we want to do the entry at the purchase date. And then we're going to want to do an elimination entry. But we need more information to do the elimination entry. And whose books is the purchase recorded on? Parents, right? Whoever the parent is, right? Okay. Whose books is the elimination entry on? Nobody's. Just on a worksheet. Got it? okay? Because it's on two different sets of books. Or if there's 100 companies, it's on 100 company sets of books, right? So, you know, you can't get the debits equal the credits. All right, so we need some other information here, though. We need to know what the equity looks like for the subsidiary. So this is the subsidiary company. Subsidiary. Which is XYZ, right, guys? It's XYZ company. So on their books, let's say their common stock for those million shares that are outstanding is let's say their common stock is $1 million. I mean, what was the par, you guys?
$1.
$1, right? It's a million shares. $1. Okay. And let's say their retained earnings is $5 million. And then that's all the equity they have. Could they have additional paid-in capital too? Yeah. You know, and they could have preferred stock and stuff. But let's say that's their only two equity accounts, okay? And then there's one other thing. Let's say on their books, book value, they have land that is valued at, I don't know, $800,000. That's its book value. The market value of that land, of that one piece of land, is $900,000. You decide, okay? So here's the deal. Because one company's buying the other, for the company that is being purchased, we can revalue all their assets at market value. The company that is doing the purchasing, we don't know what the market value of those because they're not being purchased. That makes sense? Okay, so we're not going to change the market value on the parent's assets, but we would change the market value on any of the subsidiaries' assets at the date of consolidation. Got it? So we're going to have to revalue their assets too. And by the way, you could revalue their liabilities too. We'll get to that in intermediate accounting. Okay? All right? So, yeah. So I want to increase that land in consolidation by 100,000. Got the idea? So that's going to be part of my journal entry. Now, we already did this a little bit. To the extent that I pay more than the book value of the assets I acquired less the liabilities I acquired, right? To the extent I pay more than the book value, I might be buying this appreciation, in this case with land. But what else am I buying? We talked about this. If you got a favorite restaurant, and then maybe another restaurant you don't like as well. We went to Berenice last night with this visiting guy trying to be the sheriff of county here. Nice fellow. Anyway, it was really good. Berenice over on Bardstown. Nice. Be a good place to have your folks take you when they come to town, right? It's good. Anyway, I hadn't been there before. But anyway, it's pretty good, right? So let's say that was your favorite restaurant. Anyway, that was your favorite restaurant. And then think of another restaurant that you can't tolerate, right? That kind of thing. Which one would you pay more for at your bottom? They all have tables. They all have tablecloths. They all have silverware. They all have employees. They all have, they have a building and they have all stuff. They have a kitchen, right? You'd pay far more for the one that's your favorite restaurant, wouldn't you? Why? Their reputation, you trust them more, right? Their reputation, their customer base, right? Their employees, their chef. All these things that are not on the balance sheet, huh? Right?
Yeah.
All those intangibles of the business, right? Reputation, all that stuff, right? Okay. Existing business and on. What do we call that? What do we call it?
Goodwill.
That was goodwill. Remember that? We're going to value goodwill. Here we go. This is where goodwill comes from. It's the only time it shows up on company's financial statements is when you buy it, right? That's the only time you know what it costs. So we are going to calculate the value of the goodwill here. Okay? All right, so let's give this a shot. Okay, this gets to be kind of fun. What do you want to do at the purchase date? On the parent's books, only on the parent, of course. So this is going to be on the parent's books, and then, of course, on the subsidiary's books, XYZ company is going to be their equity, right? Okay. All right, what do you want to do in the parent's books?
debit and investment in subsidiary.
Investment in subsidiary. And because you might have more than one subsidiary, put the name XYZ on it typically. That makes sense? How much do we invest? 80% of a million shares, we got 800,000 shares, didn't we? And what do we pay for it if the market value was $10 a share?
There you go.
$8 million. Good. There's nothing to this, is there? And you're going to credit something for $8 million. What do you think that's going to be? Cash. Okay? All right. I think it'd be nice when I say that the company bought land for cash at the final. Debit land, credit cash.
Please.
Yeah, I will. I will. That's how you do it. Anyway, so same thing here, isn't it? All right, so now this is what's on the parents' books, right, guys?
What does that say?
Debit investment in subsidiary XYZ company and credit cash.
No, the next,
The one that starts with the E.
Elimination journal entry.
okay.
You guys can't read my writing still? That's really awful writing. Okay, elimination entry. Elimination. I can even almost see all the letters. Look at that N at the end. That's funny. Okay, elimination journal entry. I said it when I wrote it down. Don't you have a memory? Come on. Okay, elimination journal entry, right? If anybody watched anything I'd say in a class out of context, wouldn't that be fun? If you guys really wanted to do me in, you know, you could send little clips to the president's office. And, why do you let this guy in the classroom? Look at this. Yeah. Okay, anyway. Elimination entry. Sorry, guys. All right, so I guess it's good to know what that is. Whose books is this elimination entry going to go on? Nobody's. Nobody's. Just on the worksheet, right? Good, good. On worksheet. Otherwise, it'll drive you crazy. You'll be kind of thinking, well, how do I do this, right? Well, you don't have to put it in anybody's books. Only on worksheet. Okay? And then we add it up on the worksheet, add all the companies up, and take out the elimination entry, and you got what's going to go on the consolidated financial statements. Okay, gang. So what do I want to eliminate here? We can do it a couple of ways. We can calculate everything first, or we could just start eliminating. I don't care. Might be easier at first just to start eliminating. What do you want to get rid of on the parents' books? What represents an investment in ourselves when we put the companies together? You see what I mean by investment in ourselves? It's parent company and subsidiary consolidated statements. One financial statement. What if it says investment in subsidiary on there? What does that even mean, right? Investment in yourself now. So what do we have to eliminate? Investment in subsidiary. It's got a debit balance of $8 million. What do you want to do to get rid of it? Credit investment in subsidiary. This is not going to be hard, you guys, but it gets the point across, I think. That's why I do it, of course. So we got $8 million, and that account is gone in the consolidation, right? Because it doesn't exist. You can't have an investment in yourself. Now that investment, what did we invest in? Well, part of it is that increase in the value of the land, but what did we get when we bought 80% of the subsidiary? 80% of their equity, right? We have 80% of their assets, including 80% of their land, right? And we have 80% of their liabilities. We own 80% of their equity, don't we? That's what we own. And what do the minority shareholders own? I guess they own 20% of everything. 20% of the assets, 20% of the liabilities, and 20% of the equity. Everybody good with that? Okay, so what do I want to get rid of? I don't want to just get rid of 80% of it, though. I want to get rid of all of it, because I control all of it, okay? So I'm not going to get rid of their assets. The assets are still there, right? The cash, accounts receivable, inventory, they're all still there, aren't they? I want to add their assets to my assets. Does that make sense? I would eliminate any intercompany ones. We mentioned that, right? I won't do that to you on a quiz or test or final, okay? Later we'll mess with that. All right? So I have all the assets, and the liabilities I still own them all, right? I owe the parents' liabilities, and I own the subsidiary liabilities. Make sense? So I'm going to keep those. What am I getting rid of? The investment, and what does the investment represent? The equity in the subsidiary. So that's why I gave you the subsidiary's equity up here. How would you get rid of it? If there's $1 million in par value of the stock, that's the balance in the common stock account, right? And then there's, I guess that's what it was issued for way back when too, huh? Okay, and then there's, because there's no additional paid capital, I know that, right? Retained earnings is $5 million. What do I have to get rid of? All their equity. Let's do it. Debit what? Common stock. How much? This is on the subs books, right? The investment's on the parents' books, but I don't care whose books these are on. This is only an elimination entry, huh? So I'm going to get rid of the common stock for how much? $1 million. It's gone now. I made it zero. You got the idea? That's now zero. It had a credit balance, right, guys? Equity has a credit balance. And then what else do I need to get rid of the rest of our equity? Retained earnings. And any other equity accounts I had, I'd get rid of those too. Imagine if you have treasury stock, you have to get rid of that and so on, okay? So it gets to be a pain, right? What's that?
These don't have that at all. Usually more like the credits and debits will add up.
Oh, these will. We're not done yet. You're right, 6 is not 8. That's a nice observation. Good man. Okay. Now, we have to make them balance, yeah. Okay. Actually, there are people in the world who think that we're really screwed up as accounts because we insist on everything balancing. I want to retire before they get rid of debits equaling credits, guys. Oh my God, you just write down any number you want for anything. I'll have that one. Right? You know, okay, that's what I wanted to write down in that account. So I just leave out the expenses and only have revenue. How about you? Only have assets, no liabilities. What for? Yeah. So that balancing thing is really rough. So you're right. Debits have to equal credits. What else do we need? We said we were going to revalue one of the assets, right? Which one? I said it, didn't I? Okay, how much are we revaluing it by? Yeah, it's on the books at 800. I'd prefer to have it listed at 900. So only in elimination entry, I'm going to increase it to 900. So debit land for how much, gang? 100. Okay, are we still out of balance? Yes. Okay, now what do we have here? What don't we own? But we don't have goodwill recorded. Okay? Is goodwill going to be an asset or a liability? Or an equity? What's goodwill? An intangible. I just said you were going to pay more to buy a restaurant you really liked or any business you really like versus one you don't like. You're going to pay more than the book value of their assets, less the book value of their liabilities. Why? You want their customers. You want their employees. You want their vendor relationships, their government relationships. You're paying more. What's that mean? More what? Investment, more asset. I think there's an asset I'm buying. Named? Goodwill. Oh. Don't you remember how come you guys don't know everything we ever covered? You got this right on a quiz test probably. Goodwill is an intangible asset, right guys? Yeah, okay, good. You will for the final, it's okay. And you'll be surprised how much of this you keep too and use throughout your career. It's amazing, right? People come back to their business majors and want to do intermediate accounting, like, oh gee, should I do principles? And what for? And just crank on it right at the beginning. And they're really surprised. It just comes right back. Or if you've been using it at work, it'll come right back. All the stuff you're learning in this place, you can access it whenever you want. It's out there. You won't have it at the tip of your tongue or something, but it's out there. Okay, guys, so let's get this done so we can get out of here. I got goodwill. I don't know what it is yet until I get minority interest, though. Oh, the minority interest is what, everybody? 20% I don't own. 20% of what? The assets, liabilities, and equity. Oh, it's 20% of the total equity. So this equity is $6 million, right? I own $4,800,000 of it, 8%. What does the minority interest own? 20%?
Of the 6 million?
Yeah. They own 20% of the common stock and 20% of the retained earnings. So theirs is $1,200,000. Ah, so the minority interest is 20% of the equity. And you know what? Now we can just make our journal entry balance if we want. And that's goodwill. So how much is goodwill? That's one way. 9.2 million over on this side. It's got to be 9.2 million over here. We're 8.1. That's 9.2. How much goodwill is there?
Like 3.1.
Is that 3.1? Everybody agree with that? 3,100,000. Now there's a more direct way. Let's calculate the goodwill this way. Okay? The equity of the sub is how much? How much is the equity of the sub? $6 million, right guys? 6 million. What's my share? 80%. How much is that? So times 80%. 4,800,000. Okay? How much? That's my equity, right? That's mine. How much did I invest? What's my investment? 8 million. What's the excess I paid? We'll do this again, obviously. What's the excess I paid? 3,200,000. And what did I buy with the excess, guys? Land. Increase in the market value of the land. How much? 100,000. And what's the rest? Goodwill is 3,100,000. So there's the direct way. You don't have to just be comfortable with plugging in to make your journal entry balance, right? It's the same thing, isn't it? Okay? So pound on this a bit, you guys. Thanks for showing up today. I know there's nowhere you'd rather be on a nice sunny day in November. Anybody else need their tools? You are.
Still have an 80 plus.